All right, so this is our question that we have. Yeah, this is our question that we have. We are provided with a balance sheet. We are provided with a trial balance, and it has got these details. This is our trial balance. And afterwards, we have got some additional information. Okay, some additional information on the same trial balance. So I have this additional information that we'll have to factor in. So the required is to draw up the trading and the profit and the loss account for the year ended 28 February 2017. We also have to write up a balance sheet, which is same as the statement of financial position. So we have to start with the statement of comprehensive income, and then once we are done with it, then we are okay. So I said to start with, what you have to start with is to when you are given a question like this one, you have to start by identifying which of these elements go in the profit and loss account, which of the elements go in the balance sheet. That is very, very important. You can start, if you want, you can even break down the profit and loss account into the trading part. We have the trading account and the other part that comes after the expenses. So we can start with for the purposes of this study, we can just be grouping the expenses, these elements into two, just those that go in the profit and loss account and those that go in the balance sheet. Am I audible enough? Hello?
Yes, you are, although breaking, so I don't know if it's my network or yours.
Oh. Mr. Nando, am I breaking?
No, sir. The network is okay. You are not breaking.
Okay, I think it could be the network on the other end. Okay, thank you. Why are we recording the class? Okay. So we start with the purchases. We know that the purchases and the sales, they go in the profit and loss account, right? Cash at bank and the cash that is in hand, capital, the drawings, and the office furniture, which are fixed assets. All these, they go in the balance sheet, okay? Cash at bank, cash in hand, capital, drawings, and office furniture, since they're fixed assets, they go in the balance sheet. Then we come to the expenses, which are the rent, salaries, okay? You have got two discounts. You have got the discount allowed and the discount received. So all these, they go in the profit and loss account. You have the debtors and the creditors. These go in the balance sheet. The debtors are assets, then the creditors are the liabilities. You have got the opening stock that go in the profit and loss account. The provision for bad debt goes in the profit and loss account. The delivery van is an asset, it goes in the balance sheet. The running costs, they go in the profit and loss account. And the bad debt is also an expense. So all expenses, they go in the profit and loss account. But in the balance sheet, we just put the assets, both the fixed and the current assets, the liabilities, both the current and the non-current liabilities, and the capital. Yeah, the capital structure. Those are the only things that we put in the balance sheet or the statement of financial position. Once you are done identifying like this, you have to go to the adjustments before you even start solving. Look at the adjustments, because some of the adjustments that you have to see here, they affect the trading account. So you cannot just start solving and write down entering the details in the trading account before you look at the adjustments. So consider all those adjustments that affect the trading account so that you can factor them in the trading account. So let's have this one. This one is the stock as of 28 February 2017, which is the closing stock. And we know that the closing stock goes in the trading account, that is in the profit and loss account, of course, together. We have got the wages and salaries accrued. These are accrued expenses. Now, accrued expenses are an additional of expenses, okay? Are an additional of expenses under concern. For example, the accrued expenses, as long as they are accrued, they will have to be added to the salaries. So for example, accrued wages and salaries, you add them to wages and salaries, okay? Wages and salaries, you have the figure for wages and salary. Then you will add this amount, the 330, so you have to add them. The accrued expenses simply means those expenses that have already been incurred, but they have not just been paid for. Okay, you have already incurred those expenses as a business, but you have not just paid for those for those expenses. Those are accrued expenses. So they have to be added to those respective expenses. You have rent prepaid. Now, prepaid expenses should be subtracted from those expenses. So for example, you have an expense here, which is called rent. So what you do, the amount for rent you subtract from that amount the prepaid expense, which is the rent. Subtract the rent from the rent, the prepaid rent from rent. What the prepaid rent means is that you have paid in advance, okay? So there is a payment of the rent that was made in advance. So because of that, that cannot be counted as an expense. So you subtract that from the expenses. Okay, it's no longer an expense, it's a prepaid amount. Then the van running cost owing, obviously these are accrued expenses again. So you add these van running costs, you add them to the cost that we have here. We have the van running cost here. So to these van running costs, you will add again the van running cost. These are owing, okay, the accrued van running cost. So you add the expenses, the accrued expenses. There is also a statement that there is an increase in the provision for doubtful debt of 91. Now, an increase in doubtful debt is an expense, okay? The increase in doubtful debt is always an expense. But if it's a reduction, just as we said last time, if it's a reduction in the provision for doubtful debt, that one will be added under other incomes. That's what usually happens. We are still just discussing the question so that when you start solving, you are okay. We have got the provision for depreciation, which is for furniture. We are given that depreciation was for furniture was the 330, okay, 380, sorry. And for the delivery van, the depreciation was £1,250. So what these depreciations mean is that the asset under concern, for example, the office, okay, furniture, lost the value under this particular period from 1st March 2016 up to 28 February 2017. Under that period, it lost the value of 380. That's the depreciation. And similarly for the delivery van, it also did lose the value of 1,250. So this value was lost, okay, during that period. Now, when it comes to the profit and loss account, under expenses, depreciation is an expense. But to the depreciation that you write in the profit and loss account is only the depreciation that has occurred under the period under concern. I'll repeat, the depreciation that you record as an expense is only that one which has occurred during the period under concern. For example, now the period under consideration is the period from 2016 March to 2017 February 28. So you are looking at, you are interested in the depreciation that has occurred during this period only. The other depreciations you are not interested about them. Like this, the depreciation that comes from the previous period, that is not what you are interested in. You're not interested in that. Okay. There's always the depreciation that you can have from the previous period, but you are not interested in that. What you will be interested in is just the depreciation that has occurred during the period under concern. So we have finished looking at the adjustments and how to treat them. So my question is there any question that people want me to clarify on, just based on the question first? Is there a question? Hello?
I think maybe, sir, come again on the depreciation.
On the depreciation, thank you. So what has happened is that, what happens is that from the time you buy the asset, okay, for example, this delivery van, from the time it was bought many years ago, it was losing value, some value, okay? Now, when it reached on 1st March 2016, they calculated and found the depreciation and recorded it in the trial balance, okay? Then, from that period, we are told that from that period, okay, up to 2017, in between, the same delivery van lost another value of 1,250. So this is the value that has just been lost during this period that we are interested in. And this is the value that you record, okay, under depreciation. This is the value that you record under the profit and loss account. My point is that sometimes when you're given the trial balance can still have another depreciation here. Maybe it can have depreciation for you have those trial balances. Depreciation for furniture, as that you check the date, maybe to show you March, 1 March, okay, 2016. You will not record this depreciation which is showing in the trial balance, no. Because this depreciation is recorded as at or as at on that day, as at that day, that date when they close the books. Now, you are just interested in the depreciation that is not captured in the trial balance, okay? This depreciation that has occurred during the period, this new period, from the time they close the book. They close the books, the previous books, they closed them in March, okay? Or 1st March 2016. But there is some other value that has been lost from 2016 to 2017. That is what we are interested in. Did you get it?
Yes, sir. Yes, I did.
Okay. So from there now, we can easily now start with the format. I remind you quickly, you start with the sales, right? I said you record the sales. Now, the way how this trial balance is, it shows you that the purchases are these, then the sales are these, right? You might not see clearly, this is 157, 165, okay? That's the value of sales. So when you start recording under sales, like sales, on the credit side, you record this value, 157, 165, okay? That's what you record. Then from the sales, you go to returns inward, isn't it? Or sales return. You check on the trial balance if you have sales return, all right? Do we have any sales return? We do not have any, right? We don't have the sales return or the returns inward. So it means you will not subtract because it is not there in the trial balance. Then it means from the sales you less the cost of what? The cost of goods, right? The cost of goods. Now under cost of goods, I said last time, you begin by writing the opening what? The opening stock. The opening inventory. Okay. Now the opening inventory shall not be written as opening inventory. No, you just check the date. All right. For example, here there is an inventory as of 1st March. This inventory. And how much is the stock? How much is the stock as of 1st March 2016? It should be 4,120, isn't it? Now, the period that you're considering started on 1st March 2016. It ended on 28 February 2017, 1 year period. So it means this will be your opening stock. You just check the date, okay? So you record the opening stock, 4,120 like that. Then to the opening stock, you add what? You add the purchases, right? So the purchases are already given here as 92,800. 92,800. Okay, that's what you do. You record that, and then what comes next? You less the returns outward, right? Or the purchases return. Do we have the purchases return in the question, on the trial balance? You check on the trial balance if you have the purchases return. The purchases return are also called the returns outward. And so you check on the trial balance, you find that you do not have any. So if you don't have, you cannot less because you don't have. So what you do, you have to add the carriage inward, okay? Add the carriage inward after removing the purchases return. Carriage inward, is it there on the trial balance? Do we have carriage inward? Is there the carriage inward? Do we have carriage inward on the trial balance? We don't have any, right? The figures that we are looking at are these on the trial balance. We don't have carriage inward, therefore you not add the carriage inward, okay? Then from there, the next thing is to less what? Closing stock. We less closing what? Closing stock, all right? Now, these two shall add, then you less the closing stock. So the closing stock, again, they will not label that this is the closing stock. No, you check the date. For example, here under additional notes, the first adjustment, you are told that the stock as at 28th February 2017 was 2,400. So this is the day when the books were being closed. So it will be our closing stock, 2,400 pounds. Okay, you less that. Is that clear? Right. So afterwards, see, you will add these: opening stock plus purchases minus 2,400. What do you have? What do you have? Hey. Hello, colleagues. What do you have?
94,520.
94,520. Then this amount should be subtracted from where? From the sales to give us the gross profit, right? Gross profit. So what is the gross profit? What is the gross profit?
62,645.
62.
645.
645. All right, as the gross profit, assuming that the calculations are correct. So that will be our gross what? Our gross profits. I'm just interested in you getting the format. Then after you have written the gross profit, what do you do next? According to the format that I gave you last time, you add the other expenses, right? I said you add the other expenses to the gross income. add if at all there are other expenses. So it will be gross profit. This gross profit that you have, which is let me use the red one, which is 62,645. Then gross profit, you add the other income, add the other incomes. Okay. Now, what forms other income? Okay, let's take what forms other income. What forms other income is discount received. Okay, discount received. If you have received any discount, that forms the other income, right? Discount received, commissions received, rent received, not rent paid, rent received. Okay. So let's take, do we have any commission in this question? We don't have the commission, right? Hello? There is no commission that was received, but we have the discount received. We have these two discounts. Now, the question is to identify which one is received and which one is allowed. There are two discounts here. The other one is an expense. The other one is an income. So which one is a discount received here? Between this one, which is on the debit, or which is on the credit? Which one is received? Hello? All right. So what happens is that when you go back to the cash book, if you remember the cash book very well where we started from, the cash book indicates or shows that the discount that is received is on the credit side. Okay. You receive the discount when you make payment. As a business, when you make payment, which is a credit entry, then there is that discount which you receive. It is usually, there is that discount column, which is on the credit side. Okay, that you make when you receive, like you receive a discount as a business. It is on the credit. But for the discounts that you allow, it is always on the debit side. Okay, when you allow a discount. This is because the people that are making payments, those payments are a debit entry or in your account. So they're a debit entry. So as you receive those receipts, then there is a discount column there. So that column will just record those discounts that you have allowed. Is that clear? So it's just more like the opposite, yeah, of the non-fact, but we want you to picture it from the cash book point of view, of which the cash book is what we talked about and you're fully aware of. So the discount received is 160 there. It is added as an other income. So discount what? Received. Discount received is what? 160, right? 160. We don't have any other income. If we don't have any other income, we'll add these two to make what? Total income, all right? Try to add the two and make total income. Hello? What do you find as the total income?
$62,805.
62805. Assuming this is the total what? This is our total income. We have not missed the calculations, the figures. So that's the total income. Then from the total income, what you do now? You less what? Expenses, okay? Less expenses. So what you'll be doing, you less all the expenses that we talked about, such as rent, you less rent, you less what? Wages and salaries. Now for rent, we said that there is a prepayment of rent. So what you do, you get the rent that is in the trial balance, which should be this 3,400. You remove the prepayment, which is a 230. You remove that, then the difference is what you record, okay, as your rent on the debit side, of course. Then for wages as well, there is an accrue. Since there is an accrue for wages and salaries, the wages and salaries are amounting to 31,400. Then you will add the accrue, which is 340. This accrue for wages, you add the accrue expenses. You just do that. Then you go to what else? The van running costs. The van running costs are what? The van running costs are 615. The van running costs. They are 615 plus the accrue. This one owing. The van running cost owing is an accrue 72. You add that. Okay, so you have the column of those figures. And then you put the increase in provision for doubtful debt, which is 91, as part of the what? Part of the expenses. Okay, the increase in doubtful debt. And these depreciations, the depreciation for furniture and the depreciation for van delivery, all those as total as the expenses. Then you sum all the expenses. After summing the expenses, you have a figure that you write somewhere here. Then you subtract that figure from the total income. That will give you the net what? The net profit, okay? You have the net profit here. All right. If that has been understood, then I can show you the working, how it was done. So this is what is there. Assuming that the figures are correct that we did, this is how it was presented. So you have sales, just as we said, less cost of goods, you have opening stock, you add the purchases, right? Then from the purchases, you less the closing stock, this one. You have that figure, then you subtract that figure from the sales. You have what? You have the gross profit. Are you following? You have the gross profit. Then from there, you add what? The discount received. Okay, you have this total income. Then from the total income, you less the expenses. Now I'm interested in showing you how the accrued expenses are treated, how the prepaid expenses are treated, and how the provision for doubtful debt is treated. That is very important. Plus the depreciation. Those are the four main adjustments that you deal with in accounting. Number one, the accrued expenses, the prepaid expenses, depreciation, and the provision for doubtful debt. Those are adjustments that you need. I said for accrued expenses, check, there was an addition here, right? 340 was an accrue. It was added here. You have that. Then the rent was prepaid. So I said prepaid expenses should be subtracted. So I have that. Then the discount allowed is an expense. Okay, that one which was on the debit side, it is an expense. Now you remove that. The van running cost, they had an accrue. That's why you had to add that. And you have the budgeted, which is an expense, and the provision for doubtful debt, which is basically an increase. Of course, an increase, not a decrease. If they say it's a decrease, you have to record it here under other incomes here, just below the discount received here. If it is a decrease in what? Decrease in what? In provision for doubtful debt, okay? Or in provision for doubtful debt or doubtful debt provision. Sometimes it is also called the allowance for receivables. So that decrease in the allowance for receivables is another income. You record it here. In the previous recording that I shared with you, there is such an example actually where there are calculations. Please find time to go through. Depreciation, as I said, the depreciation that occurred under concern, the period that, or during the period under concern, should be added here. And you add, you have the total depreciation here. When you consolidate all the expenses, you have this amount, 38,868. That should be subtracted from this total income to give you the net what? The net profit. Any question? Hello? Are we
No
together?
question, sir. Yes, we are.
Okay. So basically, this is the format. This is how you deal with the profit and loss account, which is the first part, the second part of your question in an assignment that says, write up the statement of comprehensive income, right? This is the statement of comprehensive income or the statement of profit and loss. It's the same thing. This is how you write. It ends on the net profit. When you reach net profit, that's why it ends, that part, which says the statement of profit and loss. Then from there, there is question in last, which is question C in your assignment. It's asking about the statement of financial position, which is also called the balance sheet. So from there, we're going to show you now how to record these same transactions in the balance sheet. There are some elements here on the trial balance that we said they go in the balance sheet. You remember them, right? We said cash, at hand cash there, capital, drawings, furniture, all those, they go in the balance sheet, yeah? And the prepaid expenses, they go in the balance sheet. The debtors and the creditors, these, they go in the what? They go in the balance sheet, okay? Plus the net profit. Those are the only things that go in the balance sheet, okay? So what goes in the balance sheet is actually capital, it is assets, it is the liabilities, okay? That is what goes in the balance sheet. So let's see how these details were entered in the balance sheet, all right? So observe now. You have seen that there is office furniture. There is this office furniture. Okay, you start with the balance sheet. Starts with the fixed assets. Office furniture is a fixed asset. Okay, the office furniture. From the office furniture, you less what? Depreciation. Remember, the balance sheet is the statement of financial position as at now. Okay, what is the value? Where is the business standing financially? That's the question of the balance sheet. So from there, you can see that you have to remove this value that has been lost from this particular fixed asset, the 380. You saw that in the trial balance. Okay, that is the depreciation that I commented much on that occurred during the period. Subtract that, then this is the net book value. This is the difference that you have. And then you have the delivery van as well. Then you less what? You less the depreciation that occurred to the delivery van. And the difference is this one, 2,500. Then you consolidate all the fixed assets, okay? This is the total sum of the fixed assets, 5,020. Is there any question on the fixed assets? The fixed assets can still include land, buildings, all those fixed assets, they are part of this. Any question? Maybe the question would be,
from me.
where did the 29 came from? It came from the trial balance, okay? From the trial balance, we have the office furniture, the office furniture details. So those things, you just get them in on the trial, from the trial balance, it is here. Okay, that's the amount that we are talking about, right? I'm sure now there is clarity on that one. Doesn't need further. And again, so from there, once you have this total assets, fixed assets or non-current assets, then you have to have the current assets. Under the current assets, you have stock. And the stock, listen, the stock or the inventory, you are just concerned with closing inventory, okay? Don't get the opening inventory. We are interested in the in the position of the financial position right now as at 28th February 2017. What was the stock? Okay, so you record the closing stock. Very, very important. Then debtors. Now, the debtors are here. You should less the provision for doubtful debt. Okay, the provision for doubtful debt. Now, someone is asking, where did the provision for doubtful debt come from? The 496. Okay, it is actually the consolidated provision for doubtful debt. That one from the previous period plus the new provision for doubtful debt. That one, the 91. So let me show you, so that at least you have understanding, not just memorizing things. Okay, check that in the trial balance. There is the provision for doubtful debt, right? We have the provision for doubtful debt in the trial balance as of March, okay? When they just, like at the beginning of the month, of the period, the financial year, they had the provision for doubtful debt of 405, isn't it? When they just opened, that was the provision for doubtful debt. Then when they closed, the provision for doubtful debt had increased by 91, which means you add this increase, right? Add the increase in provision for doubtful debt, okay? That gives you 400 and what? 96. Is it? Yes, 496 as the consolidated provision for doubtful debt. Is that clear? Hello?
It's clear, sir.
Okay. Now the provision for doubtful debt should be subtracted from the what? From the data, from the total debtors account, or from the total accounts for receivables, okay? Why should you subtract this amount 496 from the total debtors? This is because when you have this doubt, okay, it's just more like you have people that owe you a 20,000, okay? Among the people that owe you a 20,000, there are some people that you doubt if they can give you some money, and the amount that you are not sure whether you're going to receive is 5,000, right? So when you are recording, you will not record that you have 20,000. No, you record only that one where there is some surety that you're going to receive, those promising debtors, not those you are doubting. So you just record the what? A 15,000 and remove the provision for doubtful debt. Okay, those doubts, remove that amount that you are doubting if you're going to receive. All right. So that's the reason as to why the provision for doubtful debt is removed from what? From the debtors, the total debtors. Okay. And that is, if it is an increase, it is always removed that. And then the prepaid expenses. The prepaid expenses are an asset. Okay. A prepaid expense is an asset. The prepayment is always an asset. Cash at bank and cash in hand, all those are current what? Are current assets. Current assets consolidated, they have given you that figure. Okay. Now, from the once you're done doing that, you have the current assets, then you can list what? Current liabilities. The current liabilities, we have creditors, those are accounts payables. The payables account, if you may like, the payables account that adds to 5,245. Where are we finding it, Basa? We are interested in knowing where you're getting the creditors. The creditors are here, right? They are here. The first part has debtors, so these are debtors. Then the other part is for creditors. They are there on the trial balance, okay? You pick that from the trial balance. And so you have the creditors. Have the creditors, where are the creditors? So you record the amount for the creditors. Then the expenses owing or accrued expenses should be added together as an expense. Oh, sorry, as a current liability, okay? Remember that this one, these expenses, they are also added under the profit and loss account, right? You add them to the respective expenses. Then you also consolidate them here and put them as an expense, owing or accrued expense, as a current liability. Then from there, this amount that you get from this when you add the current assets, it is this one. You subtract it from this amount, which is the total. This amount actually is the total, or it is the sum of these current assets. So you subtract that so that you can have the net current assets. These are the net current assets. Okay, this amount. You subtract that from that. This amount minus this one, you have that amount. You're not seeing what I'm saying. I'm saying that you add this amount, which are total current liabilities, right? They give you this figure, okay? This figure, liabilities, should be subtracted from these current liabilities here, current assets, sorry. You have this 13,217, all right? Then the 13,217 is the one that should be added, because this one is net current assets, okay? You will add the fixed assets or the non-current assets to that, so that you can have the net current assets like that. Once you have the net current assets, it's easy. You can now say finance the buy. Finance the buy, you write capital is always there. Capital is there on the trial balance. Okay. Capital, then you add to capital, you're going to add net profit. That net profit which you have found. So it is very, very important that you find the correct net profit, because if you find the wrong net profit, just know that it will not balance. The balance sheet will not balance. So when the balance sheet has failed to balance, it's either you made a mistake in the profit and loss account. Okay, so if you have the correct profit and loss account, just know that even your balance sheet will not be affected. These are linked. Okay, what links them is just the net profit. So net profit should be added here. You add the net profit, and then you have this sum of 35,337. Then you less drawings. You subtract the drawings from that sum, and whatever you remain is the capital employed. Okay, capital employed, the total capital employed. You can see that this amount now is equal to that, right? So the net assets are equal to capital, which simply means that assets minus liability is equal to capital, which is rendering obedience to the celebrated accounting equation. So the accounting equation states that assets minus liability is equal to capital, or the other version says capital plus liability is equal to total assets. You remember that. So these are the two forms of the balance sheet, but the one that is under concern that we're dealing with now is this one. This balance sheet I've shown you is following this equation, where you have net current assets being equal to the capital employed. Any question? Is there any question?
Sir, I'm a bit behind on the less drawings, this amount, the 17,100.
Okay. Yes. So what we said is that the format says that once you say finance by, you write your capital, which you get from the trial balance, then you add the net profit. You will have this amount, 35,337. Then from there, you will subtract the drawings. The drawings are always provided in the trial balance. They are there. This figure is there on the trial balance. Then this difference is what is called the capital employed. It should always be equal to the net current assets. I don't know if that helps. Hello?
Yes, it does.
Okay.
It does.